Investors are not too happy after Oracle's most recent earnings report. So we need to discuss what we're going to do with our small position in Oracle.
It's a statistics game, and everybody's kind of soured on Oracle slash OpenAI as of late. The narrative shifts will kill you in this business. So let's focus on the business itself. And here is our pitch for Fiscal.ai.
We'll come back to this in just a moment, but just what you need to know right now is the big red line up and to the right is Oracle. They are spending a lot of money on CapEx, a lot of AI infrastructure, data center build out, and they're not making as much in revenue.
So if you were trying to figure out a company like Oracle and the really exciting things they're working on, like the Stargate data center project down in Texas, Fiscal.ai can help you attach actual financial numbers to these things and help you determine if it or a different hyperscaler stock is the better buy right now.
You can get 15% off any paid plan, including their enterprise and pro plan, with the link in our video description, fiscal.ai/CSI. Okay, we'll start with this first comment from the principal financial officer talking about their outlook full year, fiscal year 2026. They did not increase their revenue guidance. They left it at 67 billion, but they did say that they're going to be adding 15 billion to that CapEx spend to bring that to 50 billion, up from 35 billion that they had last quarter. The reason they're doing that is that their RPO, or remaining performance obligations, are expected to be 523 billion compared to 455 billion last quarter. And they expect that they'll be able to monetize that quicker. And so they're going to go ahead and spend some more money up front.
And I noticed you said expected RPO. Basically, that's long-term revenue that's expected, but there's no actual 100% firm commitment that this will actually turn into revenue. As you all probably know at this point, a lot of this is tied to OpenAI. There's probably also some of the US-based TikTok business in here as well. This is a huge RPO number. It keeps getting bigger, but essentially the market wants Oracle to prove it. And as you said, not seeing the revenue guidance increased for this fiscal year, which lasts through the spring, Q2 of calendar year 2026, investors are a bit miffed, I guess you could say right now. We went from wild exuberance 3 to 6 months ago to now, Oracle, maybe we like you, but you're going to have to prove it.
We need to see some cash flow coming in to justify all of those capital expenditures.
Speaking of cash flows, we'll get to that, but we have to start with CapEx before we talk about free cash flows.
Maybe you're getting familiar to seeing these charts. We have two of them, hyperscaler CapEx to revenue. And this is on a quarterly basis dating back to Q1 2021, and then Q4 2025 is the most recent on the right. The red line is Oracle. So that's very clear. The actual CapEx spend to what their revenue is coming in, especially in the last few quarters, is significantly higher than some of their peers.
Significant. Oracle is also a relatively new entrant to cloud infrastructure. And so that's part of the reason, but this is a pretty big CapEx to revenue number that looks more like the neo clouds like CoreWeave or Nebius than it does the other hyperscalers. The other one that has gotten pretty high CapEx to revenue spend as of late is, of course, Meta, but they generate lots of revenue and lots of profit.
Let's look at the same metric on a yearly basis. This is from 2017 to 2025, current year.
Therein you can see Oracle Cloud is a newer entrant. Oracle was still almost entirely a legacy licensing-based software business up until just really a few years ago. And then this big pivot going all in on building out cloud infrastructure has really picked up in earnest, especially in the last year. And so what does that CapEx spend do to Oracle? You can see the free cash flow in orange, which was healthy, positive profit metric up until about this time a year ago. And the CapEx started to ramp up as Oracle builds out data centers, including the big Stargate project down in Texas, nearly 10 billion in negative free cash flow this last quarter to support those projects. A little bit of a bump, though, that we talked about last quarter that impacted GAAP net income, especially.
Yeah, they decided to offload the company Ampere to SoftBank. And so you can see that bump there, 2.7 billion in pre-tax gain for Oracle, brought their net income to over 6 billion in this most recent quarter.
Yeah, and that's important to keep that in mind because Oracle, on a trailing price to earnings basis, may appear to be much cheaper than it actually is because of effects like this. Not even getting into the depreciation schedule thing again, but the big bump here actually from Ampere sale. Free cash flow, unfortunately, being this negative is also not going to be super helpful in this period of very aggressive scale out of Oracle data centers. But this is where we're at right now. And just to reiterate, what we really need to see here is Oracle start to increase its revenue guidance related to these data center build outs.
And you may be wondering, why would Oracle get rid of Ampere, a chip design company, if they're spending so much money on hardware, on CapEx? That's exactly what Larry Ellison talked about yesterday.
She didn't talk about the battle with Netflix.
He's got his own problems. He can allow his son to deal with the other problems. So they sold Ampere because they don't think it's a strategic move to continue designing, manufacturing, and using their own chips in cloud data centers. They now want chip neutrality. They want to cater to what their customers actually want. And so what does that mean? They are going to continue to buy those latest GPUs from NVIDIA, but there's going to be some room for other companies and other hardware for their customers, like maybe AMD, of course, and dare I say, Intel.
We'll see about that. We are after Broadcom earnings. We will get started on that networking sub-industry deep dive. And Intel, it seems part of Intel's strategy to start generating some meaningful AI data center revenue will include not just the CPU business, but also perhaps more on the networking side as well as they try to plug into NVIDIA's ecosystem.
And then finally, we have to talk about the balance sheet. So in the most recent quarter, you can see that the debt went up, total cash also went up, but by far spending in CapEx on hardware infrastructure increased their debt significantly.
Mostly as expected, but having total debt start to approach 110 billion. This is another risk that, of course, needs to be discounted. So the market quite unhappy with this. Again, needing proof that the future profitability will be able to service this rising amount of debt. I guess we'll just leave it at that. This is TBD. We started a very small Oracle position a few months back. At this point, we're probably looking at just selling that small position for tax loss harvesting reasons, and then we'll repurchase sometime around mid-January.
Should have bought it a few years ago when we first analyzed it.
We bought more NVIDIA, so
I guess it's a wash. We made the right decision.
don't feel any remorse whatsoever
remorse.
for buying NVIDIA.
I feel a little bit of remorse for choosing Oracle now, but it's a small position, so that's good.
It happens.